Hey everyone, welcome back to Corporate Decoder, the place where we decode the stories hidden in these massive corporate filings. And sometimes those stories are more like a thriller novel, packed with potential financial twists and turns. We're diving into an S-4 filing from Churchill Capital Corp IX that details their planned merger with Plus Automation Incorporated. This is a big one, folks, covering everything from their hefty financial tables to some seriously spicy risk factors and legal details that could make or break this deal. Stick around as we break down what this merger actually means for you. And hey, before we get too deep, if you love getting straight insights from these filings, make sure you are subscribed to the channel and check out our Discord community linked in the description below for more great discussions. This document is an amendment to a registration statement filed for a business combination, essentially a SPAC merging with an operating company. Churchill Capital Corp 9 initially hit the public markets in May of 2024, raising a substantial amount of money, and like all SPACs, they had a deadline to find a suitable company to merge with, or else they generally have to return the money to shareholders. The target here is Plus Automation Incorporated, a company focused on AI for autonomous heavy-duty trucking. They are aiming for a 2027 commercial launch, which is a huge undertaking. They've got partnerships with big names like Traton Group, Hyundai Motor Company. This is their attempt to go public through Churchill Capital Corp IX to fund their ambitious growth plans. Now let's get to the numbers, the juicy part. And woe, even in these pro forma numbers, it is clear this is a company still very much in its growth and development phase. For the 9 months ended the 30th of September of 2025, they reported a net loss attributable to common stockholders of $77.7 million. And for the year ended the 31st of December of 2024, that net loss was a staggering $61.1 million. You also see this reflected in the weighted average shares outstanding, which has ballooned dramatically, demonstrating the dilution from bringing Plusai public. Looking at the post-business combination ownership table, we see a stark difference depending on how many of Churchill's original shareholders decide to redeem their shares. In the no redemption scenario, CI Exchange CIX public shareholders would own about 19.2% of the company. But if we look at the maximum redemption scenario that plummets to a meager 2.3%, this level of redemption can significantly impact the amount of cash available for the combined company's operations and future growth, which is a critical point to consider. Alright, let's talk about the risks, and there are many. They flat out state autonomous driving technology is an emerging tech and they face significant technical challenges. They've also incurred net losses since inception and expect continuing losses for the foreseeable future. Plusai's limited operating history makes it really hard to predict their future prospects. They also caution that their technology might perform worse than expected or take longer to commercialize and scale. And get this, they mention, there are significant technical challenges to commercialize our technology. If we cannot successfully overcome those challenges or do so on a timely basis, our ability to grow our business will be negatively impacted. That is a pretty direct warning right there. Now let's look at the deal structure and the interests of the insiders. The sponsor Churchill sponsor XLLC, along with certain insiders, have agreed to vote in favor of the business combination. They're also agreeing not to redeem their shares, which is a big deal. It means they're all in on this deal going through. The document also highlights potential conflicts of interest between the sponsor and unaffiliated shareholders. This is super common with SPACs, where the sponsor has a vested interest to get a deal done, even if it is not the absolute best for everyone. They put in a significant amount of capital, to over $7 million, which makes sense why they'd want to see this through. To get this deal across the finish line, Churchill's board got a fairness opinion from Ocean Tomo. This is a third-party financial advisor saying that the purchase price is fair from a financial point of view to the shareholders, excluding the sponsor. They analyzed the situation using discounted cash flow models and compared Plusai to similar public companies. They estimated the equity value of Plusai to be in the range of $1.3 billion to $2.5 billion, with a specific scenario hitting around $2.8 billion. That is a lot of zeros, all pointing to a significant valuation for these autonomous trucking tech dreams. Financial tables analysis. Now we have to touch on the financials, and this is where things get really interesting. For Plusai, the picture is of a company burning through cash on research and development. For the 9 months ended the 30th of September of 2025, research and development expenses were $41.5 million. That is almost 73% of their total operating expenses. They're spending heavily on R&D, and rightly so given the nature of the technology. They've also got substantial liabilities related to their safes and warrant liabilities, which fluctuate with the estimated equity value. This makes sense as these financing instruments are directly tied to the company's valuation and the success of the business combination. Now, looking at these numbers more broadly, this company is in a high-risk, high-reward sector. Their strengths are clearly in their technical team, their AI-native technology, and their strategic OEM partnerships. These are solid foundations. But the weaknesses and risks are also substantial. The reliance on a limited number of customers, the evolving regulatory landscape, and the sheer technical challenge of autonomous driving at scale are all major hurdles. The financial projections are optimistic to say the least and hinge heavily on the success of their DAS model, which is still largely untested in the mass market. The difference between their IPO price and the pro forma net tangible book value per S-Hair post redemption is quite large, and that is a key point for any SPAC investor to consider. It really highlights the bet you are making on the future success and growth of Plusai. The significant dilution from stock-based compensation and the potential for warrants to be exercised also means your ownership stake could shrink. Alright everyone, that is our deep dive into Churchill Capital Corp IX's -4 filing and its merger with Plus Automation. What is your take on this deal? Are you excited about autonomous trucking, or do the risks outweigh the potential rewards? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button. It really helps the channel, and don't forget to subscribe for more analyses like this. And if you want to join the conversation and connect with other sharp minds dissecting these filings, check out our Discord community linked in the description. Thanks for watching, and we'll see you in the next one.